Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Genpact stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 6.8 billion market cap. They're trading at $38 a share, and they have 178 million shares outstanding. Genpact provides business process outsourcing and information technology. It has three segments: financial services, consumer and healthcare, and high-tech and manufacturing. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow was high in 2021, 637 million. It dropped 39% to 389 million. Their margins went from 16% to 9%, but at least they had positive free cash flow. Then it improved in 2023, up 11%, up another 6% in the trailing 12 months to 460 million. Their margins at 10%. Net income is the profit or loss on the income statement. It's revenue minus expenses. That peaks in the trailing 12 months, 648 million. So maybe they're spending more on CapEx the last few years, which is why their free cash flow is lower than their net income. Revenue is sales for the company, and that goes up a little bit each year from 4 billion to 4.6 billion. They do pay a dividend, 1.6%, which they can cover 4 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 11 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $9.8 billion. We divide that by 178 million shares. And we get a calculated stock price of $55. They're trading at $38, so they're trading at a 31% discount. It's a buy according to the model. Do you think it's a buy or a sell? Let me know in the comments. There are 59 companies in the same industry as Genpact, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a little more than the median in CapEx, 77 million. These are the investments in property, plant, and equipment. Debt to equity ratio is okay at 0.8, a little better than the average. Surprisingly, they pay a dividend. There are companies a lot bigger than them that do not pay a dividend, and their dividend is equal to the median. They generate 460 million of free cash flow, which is worse than the average. They rank 17th in market cap at 6.8 billion. Their price to book is almost at the median. They have the best PE ratio of any company on this list. It's 10.5. A really good price to free cash flow of 15. And price of sales is a little worse than the median. So good price multiples. They appear undervalued according to these numbers. They generate 4.6 billion of revenue, a lot lower than Kyndryl. We'll be doing a video on them later. And their 5-year annual revenue growth rate is 7%, a little worse than the median average. Here's their latest income statement, the second quarter of 2024. Revenue 1.2 billion, up from 1.1 billion. Cost of revenue is also up. It's 759 million. These are all the expenses directly tied to generating the revenue. Gross profit is up a little bit from 390 million to 416 million. Their biggest operating expense is SG&A, 240 million. Gross profit minus operating expenses gives you your operating income. That's 170 million. Their pre-tax income, 160 million. Their tax rate is about 25%, 40 million of taxes. So net income is up a little bit. It was 116 million, now it's 122 million. EPS 68 cents. They're buying back stock, which is what you want to see. It went from 183 million, now it's 179.7 million. So to summarize, I have them trading at a 31% discount. I rank them 8 out of 10. Would I buy them? 8 out of 10. They look like a pretty attractive company. Great ratios. They have the best PE of anybody in this industry. Price to free cash flow is also really good. And price to sales and price to book are at the median. Financials not as good, 6 out of 10. Their free cash flow has come down, and their revenue is not growing that much, only up 14% since 2021. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.